In fact, after a long time, banks, which includes SFBs, have lost market share, 51% currently versus 60% in FY21 to NBFCs. To discuss what's buzzing in the space, now we're joined by Alok Misra, CEO and Director at MFIN. Mr. Misra, afternoon, and thank you very much for joining in. In your conversations as the head of MFIN, the organization which sort of leads the microfinance institutes listed and present in India, can you tell us what your conversations are like with the companies? What's the kind of growth we should expect for the industry in FY24, FY25? What are the key concerns? What are the opportunities as they tell you?
Yeah, thank you, and good afternoon to you. I think in your introductory remarks, you already talked about growth returning, portfolio quality also improving, and all those factors. And that is borne out by data. And let me reiterate that in the past year, that is FY22-23, as you rightly said, the growth has returned back to 22%. But as an SRO and the industry association, we track the portfolio quality also more closely. While growth is, yes, desired, but the portfolio quality, how the credit quality is behaving, especially coming on the back of 2.5 years of COVID, was a major concern. And when I see the comparative figure, if I take March 2019 figures, and if I take March 23 figures on credit quality, it is almost a similar figure. So what it shows is that the credit quality in case of disbursements post-COVID has returned back to normal times. The growth, as you rightly said, last year we saw 22% growth. The regulatory regime which changed last year, which was a very welcome move, which we have been advocating, leveling the field across there. That's the implementation is now should be what we hear is now it is in full force, which we are trying to check through field verifications also. That's also a positive step. So the sector is in a normal state. It is poised for continued sustained growth. And you asked for what would we as an industry association look for growth in next year, that is FY 23-24 and 24-25. I think going by the past trends and the pent-up credit demand, I think it will range in the sector as anywhere between 20 to 25%. That should be a temperate and a sustained period of growth, which we should see in next 2 to 3 years.
Okay, 22 to 25% growth is what the sector is looking at in next 2 to 3 years. Mr. Misra, you also spoke about quality of credit. Can you give us a sense of how the asset quality is looking right now when you say it's at par to normal levels? Is there a scope of improvement from here on?
Yeah, I wouldn't say there is much scope for improvement because the microfinance sector, we already, if you see the 20 years or 15 years of track record, it is almost 98.5 to 99% recovery. And going beyond that, talking about 100%, 99.5, I think it is a little unrealistic. We lend to clients which are economically on a lower strata, and there can be periods of genuine stress, not willful default, but so that we have to ignore. But 99%, 98.5% is great. And if I talk to you about, because we measure credit quality based on what is the demand past due or the portfolio at risk buckets, whether it is due 1 to 30 days, 30 to 60 days, 60 to 90 days comparison. And let me give you one measure. In March 19, when I earlier talked about March 19, 1 to 30 days portfolio quality risk was around 1.33%. It has now in March 23 gone down to 1.13%. So it is not only comparable, it is even better. And similarly, across buckets, timeline buckets of overdues, it is similar. Only in case of far more than 180 days, it is higher. And that is because of the COVID old loans, which have gone into higher brackets, that is 180 days and above. There, that effect will be there. But there also, there is not a cause of worry. Let me re-emphasize that. Because the institutions have already taken full provisions under the RBI's provisioning norms. It is only being carried that in case there are chances of recovery, the effort should continue. So the credit quality has almost become similar to March 19 or better.
Got that. Mr. Misra, could you repeat the system-wide gross NPAs, say as of FY23 end for the MFI sector? What's the number?
Yeah. And when I say about the sector, it includes banks, microfinance portfolio, small finance banks, NBFC, MFIs, and NBFC. All four are regulated institutions which take And if you talk about, because NPA is 90 days plus, and if I talk about 91 to 180 days, it is at 1%, that is 0.96%. But if you talk about 180 days plus, because that has also been included, that is 8.5%.
Okay. So what is the outlook? What is the outlook on net interest margins in that case? Because we've seen rise in cost of funds. Has that been passed on? What is the outlook as far as the net interest margins for the industry is concerned?
I think, net interest margins regime will remain stable because of two factors. One, despite the regulatory freedom to price your loans based on your cost of funds and risk cost, because of the market competition and because of the sector to which we cater to, part of the increase in the repo rates and all that, which is now at a pause, 200 basis points increase in repo, that got passed on to the wholesale funding of banks to the NBFC and MFI. So that has resulted in a, I would say, rise in interest rates at the end client level of, I'd say, 150 basis points to 175 basis points on an average. But now that the repo rate has paused, and maybe in future we will look for some decline of whatever it is, with a time lag, it will come there. But the interest rates in microfinance sector in last 2 years, or 1.5 years especially, since the rate hike cycle began, has not gone beyond 150 basis points on an average.
Okay.
And you talked about, sorry, to answer your question, you talked about interest NIM guidance. I think the NIM guidance will remain same.
Okay. So you don't anticipate NIMs to contract?
Generated in pre-COVID years. No. No.
Okay. So getting back to the gross... Go ahead.
Sorry. Please continue. Please. No, I was saying that NIMs will not contract because the effect of COVID losses and the provisions which have to be taken have already been taken. So that effect will not be there. And the future credit quality, as I told earlier, is looking similar to what it was in pre-COVID. So the freedom to price your loans based on risk cost is also there. So NIM will not contract.
Okay. So you're comparing the NIM to pre-COVID, or you're comparing the NIM to FY24 NIMs versus FY23? Very quickly.
No, I'm comparing NIMs to the period, normal NIMs when it was pre-COVID.
Pre-COVID, right? But sir, year-on-year NIMs could contract.
No, I don't see any reason for NIMs to contract because the spread will remain the same.
Mr. Misra, we've unfortunately ran out of time, but thank you very much for joining in and throwing color on the state of the MFI industry in India. Market's still holding up firm with a gain of 50 points.